Okay, class. Good afternoon, everyone. Kindly confirm that you can hear me clearly.
Good afternoon, sir.
Okay, great. So you're welcome. Today, we have quite a number of topics that we need to cover. We'll be looking at IAS 23. We will also be looking at IAS 20. We'll also be looking at IAS 40. I started IAS 40 yesterday for my physical class students, but we could not finish it, so we'll finish it. I will start over because my virtual class are also right here, right now. I would also look at IFRS 5, which I've done already. So when I'm doing IFRS 5, the physical class student can excuse us because I've done it yesterday. These are short standards that I intend to finish in this session. So for us, my virtual class students, we are also going to be meeting up in our second period. And for that period, we are going to be looking at financial instruments. Mr. Ibrahim just told me that he will not be having, he does not have sufficient time to teach you that. So I will have to teach you that. He also noted that I think he hasn't done one other topic like this that he was supposed to take. I will also be teaching you that as well. So let's get to business. IAS 20 on borrowing costs. So what we want to learn here is basically the accounting treatment of interest on borrowings, which the standard describes as borrowing cost. So when you borrow money and you pay interest, how do you treat it? However, the scope of what we are looking at is basically first, that what you are borrowing for must be a qualifying asset. You must be borrowing for a qualifying asset. If you are borrowing for any other intent and purposes, whatever it is I'm discussing here today will not fly for that. So, yes, what we want to learn is how to treat the accounting treatment of interest on borrowing, which is borrowing costs. But the key question that begs an answer first is that this item, this borrowing, what's the intent? What are you borrowing money for? What do you want to use the money to do? If it is for a qualifying asset, fine. IAS 20 applies to that. Therefore, what is a qualifying asset? You see, it is an asset that takes a long period of time or a substantial period to
Hello,
get
sir.
ready. Yes, Prince.
Hello, sir. Is it IAS 20 or 23? Borrowing cost, is it 20 or 23?
It's 23. Thank you. Thank you, Prince.
Mm-hmm.
So 20
Hello, sir.
is government grant. Thanks. So we're talking about qualifying asset. We said this is an asset that takes a substantial period to get ready for its intended use. So We're talking about a building that you are constructing. Or it could be any asset that you are constructing, whether a building, a plant, or machinery that you have to construct yourself. So if you borrow money for that, then it's accounted for based on the principles in IAS 23. However, know that this standard does not apply, or yes, this standard does not apply to any assets that is measured at fair value. So if you have any plan, I'm back. So as I was saying, if you have any plants or any assets that you are constructing, but that asset you are measuring it at fair value, then whatever I'm going to teach you here does not fly. Now, what is then the treatment of borrowing cost itself? So borrowing costs that are directly attributable to the construction or production of a qualifying asset should be capitalized. And you know that when I say capitalized, I mean it should be added to the cost of the assets. That's what we mean when we say capitalized. So any borrowing costs that are directly attributable to the construction or production of a qualifying asset, capitalize it. And at the very simplistic level, example of borrowing cost is basically your interest on loan. If you take loan from the bank and you have to pay interest on it, or it can be even as simple as bank overdraft. They are usually capitalized. And that's the key treatment. Any borrowing costs that are directly attributable to the construction or production of a qualifying asset, capitalize them. But another key thing is this. When do you commencement of capitalization of borrowing costs? When do you commence capitalization of borrowing costs? When do you commence it? So the following conditions must exist before capitalization of borrowing costs can commence. Number one, expenditure must be incurred on the assets, we must see that you have started incurring expenditure on the assets. You have started, if it is a building you want to construct, you have started clearing the land, you have started trying to get building permits, you're already engaging architects to start drawing the plan. Expenditure must be incurred, or let me say, is being incurred on the asset. Number two, borrowing costs is also being incurred. You must have borrowed the money. You must have borrowed the money. You must have started paying the interest. You must have started paying the interest. Number three, so activities must be in progress or in place to get the assets ready, for its intended use or sale. Activities must be going on, even if you have not started construction. There must be administrative activities that you have started. Like I mentioned earlier on, if you have to start getting permit from the government, if there are necessary regulator that you need to meet to get things ready, you must be seen to be committed to that asset. Activities must be in progress to get the asset ready. And the thing is that if one of these conditions is not met, you cannot capitalize borrowing cost. We expect every one of these conditions to be present. So if they ask you in the exam, we expect you to mention all of it. We expect you to mention all of it. Another one is this: suspension of capitalization of borrowing costs. Can you suspend capitalization of borrowing costs? Yes, borrowing costs should be suspended where there is a delay that is avoidable. So where there is a delay that you can avoid, whether it's permanent or whether it's temporary, you need to suspend capitalization of borrowing cost. You have to stop. Because if, for example, you stop construction, you stop active construction on the site, on the project, you did not construct again. Not the one that is unavoidable, not when you are doing a construction and you get to the decking stage and you have to leave it for some days for it to dry before you continue. Or maybe government came to do inspection and they have to do some tests and all of that then. Or maybe there is seasonal change, maybe rainfall or an adverse weather that obstructed construction activities. Those ones, you can't avoid it. There is nothing you can do about them. Or any delay that is a major component of the construction itself, that you need to wait for those period. So, but if it is a delay that you can avoid, so you should suspend borrowing cost capitalization of borrowing costs. Capitalization of borrowing costs should be suspended where there is an interruption of active development of the assets as a result of avoidable delays. Okay? There are avoidable delays. There are things that maybe it's because you didn't have money, you now stopped. Or maybe because you didn't pay people that are supposed to work, you now stopped. Where there is an interruption of active development of the assets, you need to stop. You cannot continue to capitalize, even if you are paying interest to the bank. You need to stop capitalizing it. And what that means is that whatever interest you're now paying will be expensed. To be expensed, you take it to profit or loss. And finally is cessation of capitalization of borrowing costs. At what point do you stop capitalizing borrowing costs? So where all activities relating to the construction have been completed. It's not when you start using the asset, it's when you have completed construction. Okay. But if in a situation where the construction will be finished in parts, where you have multiple projects, then capitalization of borrowing cost can also be seized or stopped in parts. Okay. So what is important is when all activities relating to the construction have been completed, then you can stop capitalizing the borrowing costs. So another very simple question is how much borrowing costs? How much borrowing costs should be capitalized? It sounds simple, but that's the core of this topic. How much are you capitalizing? Abi? So because I say capitalize borrowing costs, does that mean that if you borrow 1 billion and the bank says, okay, you are paying 10%, I mean, hypothetically, you're paying 10% per annum, that's like around 100 million. So how much are you capitalizing the whole of the 100 million? No, you're not. Okay. So even though the standard says that capitalize borrowing costs, so what you are capitalizing depends on how much of the money you spent on that construction. You cannot borrow 1 billion and you have only spent 100 million on the assets. And you cannot capitalize the whole of so it will be allocated based on how much you have spent so far. It will be allocated based on how much you have spent so far. So if you have not spent the entire money, you cannot capitalize the entire money. So the amount of borrowing costs, or let me say the proportion of borrowing, because the borrowing cost, no doubt, is the interest times how much you have borrowed. But is it everything you can capitalize? No. If you have not spent the whole of the money on the construction, you cannot capitalize that portion now. So the proportion of borrowing cost that is capitalized is based on the expenditure is based on the expenditure incurred on the assets. Okay. And this can now vary and all that. So there are different issues that you're going to then look at. Okay. There are two issues, because when we say based on the expenditure incurred on the assets, so there are instances where we would have specific borrowings, okay, where a borrowing is obtained specifically for an asset. So in this case, the borrowing costs that is capitalized is based on the expenditure incurred or the amount borrowed. So depending, if you have spent all the money on the construction, if they didn't tell you that you didn't spend all the money, they didn't tell you that if you have spent all the money on the construction, then your borrowing cost is based on the amount you borrowed. If you have not spent all the money on the construction, then the borrowing cost will be based on just the amount you have spent. Okay. And there is general borrowings, where a construction project is being funded from a pool of funds or borrowings, meaning that unlike specific borrowing, where you borrowed money specifically for this, but this one, you have a pool of funds, a pool of borrowings that you did not even get at the same rate. So you're not using it to fund one or more construction projects. Then which interest rate are you going to then capitalize? Which rate are you going to use? So the borrowing cost here would be based on the capitalization rates, that is determined based on the proportion of the expenditure incurred on the project. So this will become clearer with an example. So I will solve two questions that takes care of everything. One on specific borrowings, one on general borrowings, and that will take care of how much borrowing cost do we actually capitalize. And that is all for borrowing costs. The core concepts here that you need to know are, one, is that when you want to capitalize borrowing costs, you know that what you're using the money for must be on a qualifying asset, to acquire a qualifying asset. And a qualifying asset is an asset that takes a substantial period of time to get ready for its intended use. So and when you have this borrowing cost, it's usually capitalized. Anyone that you'd that money you borrowed for construction or production of a qualifying asset, you capitalize the borrowing cost. And you start capitalizing when these three conditions have been met. If they are not met, if any one of them is not present, you cannot capitalize borrowing cost. And you can suspend. There could be a temporary suspension of borrowing cost when there is an interruption of active development of the asset as a result of avoidable delays. You should stop capitalizing, except where the capitalization, except where the active development is beyond your control. Like maybe is a delay that is inbuilt in the construction process itself. There's nothing you can do about it. I mean, you all remember during 2020, during that COVID period, assuming you had borrowed money to facilitate a construction activity, and you are still paying interest doing that, you still capitalize it. You will still have to capitalize it at that point in time. So you stop capitalizing when construction activities have been completed. You stop capitalizing and all that. So now let's solve these two questions. Then we'll end it on borrowing cost. Before I solve questions, do you have any questions for me? Okay,
Sir,
Sharafa,
I have a question.
please
Okay,
go
sir.
ahead.
Hello, sir. Good afternoon, sir.
How you doing?
Fine, thank you, sir. I just want to draw your attention to this suspension of borrowing costs. So, I think is what we have there should be unavoidable delays, because if delay is within my capacity, then or am I the one mixing it up?
No, you can explain it further now so that we can think it through together.
Capitalization of borrowing costs should be suspended where there's an interruption of active development of the asset as a result of avoidable delays. So, if delay is avoidable, then that means it's beyond my control. Or am I the one mixing that in the show? But
Is avoidable. If it's avoidable, that means it's within your control. It's something you can avoid if you act like the way you're supposed to act. It's something you can control. Like Omonile, for example, they came to stop you guys. These are avoidable delays.
Okay, so it's correct. Thank you, sir.
Yeah. Yeah, thank you, Sharafa. Thanks. Yeah, Fashion.
Yes,
I
sir.
have a question.
Okay,
Okay.
yeah. You would come in after Fashion, Lukman.
Good morning, sir. Thank you, sir. Yes, I wanted to ask that this the interest, like when a company borrows money and they capitalize it on the assets, that interest that they're paying every year, would they also be adding it to the historical cost of the assets as well?
And that's the whole idea. That's what we're
Okay.
talking about. So, so that's everything I've actually talked about. That when I say capitalize, I mean it to be added to the cost of the assets. But as soon as construction activities have completed, as soon as you have finished construction, you would stop capitalizing. As soon as construction is complete, capitalization should stop. So when I
Okay.
say
So
capitalizing, it means add it to the cost of the asset.
okay. So if like the loan is still there, even after the asset has been fully built, that interest will not add it to the cost of the asset. We'll just add it to your expenses.
Yes.
Okay, so
Lukman,
Good afternoon.
good
My own
afternoon.
question, like in the construction world, there are
Yeah.
some expenses that will pay to all these labs card, is building control and some. And at times, some of these people still come to construction site. At times, you pay them 100, 200,000 for visiting the site, and so that you can keep working. Those kind of expenses, can it be capitalized or they should be expensed?
Okay, so you're taking us away from IAS 23. That's totally IAS 16. And that's talking about directly attributable costs of getting the assets ready for its intended use and sale. So we could say, that directly attributable costs should be initial delivery and handling. You could categorize that as part of your handling cost. Or alternatively, you could categorize that as part of maybe regulatory fees or professional fees, something like that. So it's capitalized.
Okay, thank you.
If you don't pay it, you won't complete construction.
Thank you.
Yeah. Now let's solve two questions. Number one, it says on 1st January, these two are actually past questions. So just to make our life easy. So it says on 4th January 2016, Wellman Limited borrowed 1.5 million to finance the production of two assets, both of which were expected to take a year to build. Work started in 2016. The loan facility was drawn down and incurred on 1st January 2016 and was utilized as follows. The remaining funds invested temporarily. So there's a plant and a building, 1st January 2016, 250K, 500K. 1st July 2016, 250, 500. The loan rate was 9%, and Wellman can invest surplus funds at 7% required, ignoring computing compound interest, calculate borrowing costs, which may be capitalized for each of the assets, and consequently, the costs of each asset as at 31st December 2016. Okay, if you look at this question, at the beginning of 2016, we borrowed 1.5 million. We borrowed 1.5 million. And they want to use that money to finance production of two assets. So that's fine. So that means that asset is a qualifying asset. So any interest we pay on this borrowing, we are going to capitalize it. Now, both of which were expected to take a year to build. Work has started in 2016, and the loan facility was drawn down and incurred. Was drawn down means they started spending the money and they utilized it as follows. So they had some remaining funds. Now, the first thing you need to understand is the fact that this is a specific borrowing. It's a specific borrowing. And how do I know? Specific borrowing is just a single borrowing. Is a single borrowing. A borrowing where you can know the rate to use. Because this one, I know exactly that the loan rate is 9%. So that's a specific borrowing. You will see the second question that is a general borrowing. You see us, they will have plenty loans. And the question then becomes, which rate are we going to use? That one is a general borrowing when you start asking that question. So in that wise, this becomes straightforward because first, this is a specific borrowing and the entire borrowing was incurred on the assets. They incurred everything on the assets. For that reason, the borrowing cost is computed on the amount borrowed. So borrowing cost is simply 9% times 1.5 million. That's the interest. Now, whatever you get here, the standard says that because this question mentions something that they invested remaining funds temporarily. And wait, how did I know that the entire borrowing was incurred on the asset? Can anybody answer that? How did I know that? How do you think I knew that the entire borrowing was incurred on the asset?
They said that they borrowed 1.5 to finance the production of two assets.
Okay.
And both expected to take 1 year to build.
Okay. You have not answered the question.
Hello, sir.
Yes, I'm with you.
Okay, the cost of the asset is the cost to build the asset is 1.5 and they borrowed the 1.5.
Thank you very much. That is it. That's the answer. The expenditure incurred is 1.5. They borrowed 1.5. That's the answer. Look at in January, 750. In July, 750. That was what they mean by drawdown as followed. So they didn't spend all the money once. Bam. They did not spend all the money once. So in January, they spent 750. They were working. In July, they incurred another 750. And that's where this surplus fund is coming from. That's where this surplus fund is coming from. Now, if I may ask you again, the surplus funds, will it have been invested between January and June or invested between July and December? Where is the surplus funds would have, at what point do you think they would have surplus funds?
January to June, sir.
Thank you very much. Intelligent. So it's January to June because since they only spent 750 January to June, that means they still had extra 1.5. So we need to deduct that. You need to remove that surplus funds from that. So let me call that investment income. And they got 7% from investing surplus funds. And how much surplus funds did they invest? 750,000. But you need to remember that they didn't invest it for 1 year. This 7% is per annum. They invested it only for 6 months. So it's 6/12. So what do we have?
26 to 50
For which one?
for the investment 6 months
What did you call it? 26
to 50.
to 50. What about the borrowing cost?
The borrowing costs were okay.
135.
135.
135,000.
Yeah.
$108,750.
So this is the capitalized borrowing cost. And that's your answer. 108,750, Abi?
Yes, sir.
Yeah. So the challenge then becomes, out of these amounts, how much are you going to capitalize for plants? How much are you going to capitalize for building? Because you cannot just capitalize everything and say capitalized. How much is going for plants? How much is going for building? The standard says it's based on their proportion in the expenditure incurred. So for plants, so the borrowing costs capitalized for plants is going to be 500 divided by the total 1.5 million times 108,750. Borrowing costs capitalized for building is going to be, that's 1 million divided by 1.5 times 108,750. So how much do we have in each of those scenarios?
36 to 50.
36 to 15. How about this?
72,500.
Okay. So we have gotten the interest. Now let's determine costs of the assets. So we have plants and we have building. So for plants, cost of the assets for plants was incurred 500,000. This is one. Borrowing costs. This is 36 to 50. This is 72, 500. $536.25 1072.5. Okay, and that's the end of this question. So again, this is easy, but you have to be very careful because you need to understand certain things so that you won't make mistakes. So first thing I looked at is I identified that this is specific. I need to know that this is a specific borrowing because I can easily trace how much interest we are capitalizing. That okay, it's 9%. I was able to identify that. When you have identified that, the next thing is that how much did we borrow? How much did we spend? If you spend all the money, then fine. Just calculate the borrowing cost on all the money. Then you can then share whatever you get based on the proportion of expenditure incurred if there are more than one asset, which is what we did here. If the money they incurred was less, the interest will be calculated on the expenditure incurred. On the expenditure incurred. So those are the indicators that you pay attention to when solving a question on borrowing cost. Is it that you calculate it on the entire borrowing or you calculate it on the expenditure incurred? Any questions? Okay, let's solve the next question.
Please, sir, how did you arrive at the cost of the asset? This 536. No, just
Okay.
there. Yes. 536.25.
Is the addition of 500 plus
Mm-hmm.
36.25. And this is the 36.25 here.
It's okay.
Okay.
Thank you, sir.
You're welcome. Any other questions before I move ahead? Okay. We have Power Limited had the following loans in place at the beginning and end of 2016. So there is a 10% loan that is repayable in 2018. There's a 9.5% bank loan repayable in 2019. There's an 8.9% debenture repayable in 2017. We're also told that Vivian, that the 8.9% debenture was issued to fund the construction, of qualifying assets, a piece of mining equipment. The expenditure was 40 million, construction of which began on 1st July 2016. And also, we're now told that on 1st January 2016, the Power Limited began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. Expenditure drawdown for the construction was 30 million on 1st January 2016, 20 million on 1st October 2016. Calculate the borrowing cost that can be capitalized for the piece of mining equipment and the hydroelectric plant. Actually, so here now, something is clear here now, is that this is a general borrowing. This is a general borrowing because we have plenty borrowings, not just one, plenty. So there is a 10% that they took in 1st January 2016, and they are supposed to pay back in 2018, which is, that means how many year loan? 16, 17, 18. That's a 3-year loan. This other one too, they took it also in the same period, and they are supposed to pay that in 4 years, 16, 17, 18, 19, 4 years. And there's an 8.9% debenture repayable in 2017. So they're supposed to pay this in 2017. But they took this, they didn't take this loan at the beginning of the year. They took this loan. They didn't tell us when they took it, but we can see that the loan is sitting in the books at the end of the year. So now, what did they use the loan for? The 8.9%, they used it to fund the construction of a qualifying asset, a piece of mining equipment. The expenditure was 40 million and construction began on 1st July 2016. Now, for this one now, this one is a specific borrowing, okay? Because this 8.9% was issued to fund a piece of mining equipment. So I can say that as far as this one is concerned, they borrowed this one specifically for the mining equipment. So it's specific. So this one, I can easily calculate the interest. I will use 8.9%. However, on 4th January 2016, they began construction of another qualifying asset, which is a piece of machinery for hydroelectric plants. That's a different project from this mining project. It's a different project from that. So now they decided to use existing borrowings. So they want to use this 10% bank loan and this 9.5% bank loan to fund that. Okay, so that's a general borrowing. When you're using pool of funds to fund either a single project or a multiple construction, that's a general borrowing. Okay, so, and the expenditure drawdown for the construction was 30 million in January, 20 million in October. So let's resolve this. Let me start with the simple one, which is the specific borrowing. So you see that the 8.9% debenture is a specific borrowing. Okay. And that's because it was expended for a specific asset. It was expended for a specific asset. So in that case, we can easily calculate our borrowing costs. Now, in this case, so since the amount borrowed, or since the borrowing, the amount borrowed is higher than, you don't need to cram this, so that's how I just want to express my own in my own terms. What is important is that they did not spend all the money for the construction. So they borrowed 150 million. They only spent 40 million. So we don't expect you to capitalize 8.9% of 150 million, which is the interest you will pay to the bank anyways. So we don't expect you to capitalize all that. You only expect you to capitalize to the extent of the expenditure incurred. So the amount borrowed is higher than the expenditure incurred on the assets. So the borrowing costs will be calculated based on the expenditure incurred. So our borrowing cost, therefore, would be 8.9% times 40 million. What would that give us? What is 8.9 times 40 million?
142,400.
142,400. 142,400. 142,400K.
That's not what I got though. I got 3,560,000.
Correct.
3 million.
560.
But now, another challenge is this. These guys started construction in July, and it makes sense because that also means that they will have borrowed the money around that period, because this debenture didn't come in at the beginning. It was not there at the beginning of the year. They will have borrowed it. They didn't tell us. So these amounts here now is for a year. Is a 1 year interest. And we cannot capitalize 1 year interest. We would prorate that by 6 months. So if you divide this by 2, what will it give you?
1780.
1780.
1780.
80.
Okay, 1780. So, and this is the amount of borrowing cost you can capitalize. And the way I got the 6 months is that they began construction in 1st July. So from 1st July to December, that's 6 months. So the second one, so the next project, the hydroelectric plants. Hydroelectric plants was financed or funded from a general borrowing. So the borrowing cost will be based on a capitalization rate. So we need to determine a capitalization rate to know how much borrowing costs. So, and how do you determine the capitalization rate? There are different ways of determining it. So you can look at it that you have 2 loans, 10%. That one you borrowed 120. 9.5%. That one you borrowed 80. So together is 200 million. Together is 200 million. So you can do 120 divided by the total times, what's the rate for that? That's 10%. Plus the second one, 80 over the total times, what's the rate for that? 9.5%. $120 over 200 times 10% plus 80 over 200 times 9.5%. So this will give us capitalization rate. So it's like using a weighted average based on the amount borrowed. So for the first, we did the amount borrowed divided by the total times the interest. For the second, amount borrowed divided by the total times the interest. So can you punch your figure, your calculators for me?
%9.8.
9.8%. So with this now, we can then compute our borrowing costs using 9.8%. And clearly, we borrowed, this one will be calculated on the expenditure incurred. So 30 million in January. So 9.8% times 30 million plus. So ordinarily, I can just do 9.8% times 50 million. But the reality is that for this general borrowing now, it depends on, I need to separately calculate the borrowing or the interest on the expenditure incurred based on when the money was spent. So this one, the money was spent from January, so I'm calculating 12 months interest. This one, it was from October, so I'm calculating 3 months interest. And that's because the whole money was not incurred on the asset. Okay. So can you give me the answer to that? Then I can attend to questions afterwards.
3,430. 430.
Okay. So, and that's what they want us to calculate. So all you just need to do, this one will be added to the cost of the assets. Though they didn't ask us to calculate the costs, but you're definitely going to add this amount to 40 million. And you're going to add this amount to the 50 million. 330 plus 20.
I thought
Okay.
we want to prorate that 20 million.
You did, no?
Okay.
You did.
Okay. You can ask your questions now.
So sorry, you didn't put 3/12 for the 20 million.
Oh, okay. Thank you. 3/12. I can see your hand, Clement. You can ask a question, you know?
Okay, good afternoon, Mr. Austin.
Good afternoon.
I have two questions.
All right.
One, I think I'm a bit lost on how we got the 9.8. And for the second line with the borrowing cost, I thought 30 million, we got it around July. So I was thinking we're going to prorate that one by 6/12.
Which one? This 30 million?
Yes. Oh, it was January. Oh, okay. Okay. But I think I'm a bit confused on how we got the 9.8.
Oh, okay. So you have to learn this. It's because they funded this project from a pool of borrowings. From a pool of borrowings, there's 10%, there's 9.5%. So you need to use like a weighted average. So I used based on the amount borrowed to get like a weight, like an average rate. So I did 120 over the total, which is 200 times 10%, then 80 over the total times 9.5%. So it's like a weighted average of these two based on the loan amount, based on the portfolio itself, which is what I did here. So 120 over 200 times the interest rate on the first loan. 80 is the amount borrowed on the second over the total times interest on the second loan. If you punch your calculator, should give you this. Should give you this. You can do this one separately. You can do this one separately and add them together. Gives you this. I don't know if that helps you.
Yes, yes, I understand now. Thank you.
Okay. Moses, go ahead, please.
Yeah, good afternoon, sir.
Good afternoon.
Sorry, I want to know if we need to consider projects completion period here when we are calculating borrowing cost. I don't know if you get the question, sir.
So when they finish the project, Abby?
Yes, assuming you obtain the loan January, then you are expected the loan interest is being given to you is 1 year, and project is being completion within the year.
Yes, now that means you will just prorate the borrowing costs. You prorate it.
Sir, what if the project is extended to the following year? Like the
That
project
means
is for 2 years. Do you compute borrowing cost for 2 years or you do for 1 year?
it's for 1 year. You know that accounting is per annum. So, and you don't even pay the interest for 2 years at the stretch. You pay it per annum. So is this year you will do borrowing costs, capitalize, next year another one like that.
All right, thank you, sir.
Sir, I wanted to ask that, sorry, if you can go back to the schedule or in the question.
The schedule?
Yes. This one, yes. This January. If there was an increase in, like, January was 120, December 130, 80, and 90. If there was an increase, are we going to, when computing our weighted average borrowing cost, are we going to only use the year end or there's something we're supposed to do?
You use the year end. There's really nothing you're going to do. It's just the pool at the end. That's the nominal amount you use to calculate your weighted average rate or capitalization rate.
Okay. Then, sir, I wanted to also ask that, for instance, here we saw that they used 40 million out of the 150 to start construction on the qualifying assets. The other balance, that's the 110, would be seen as loan.
Surplus.
Okay, surplus.
The surplus fund, but since they didn't tell us what they used it for, so we cannot assume that they invested any surplus funds. And probably maybe they are using it for something else. They are the one that know the reason why they collected 150 million when the only money they needed was 140 million. So they didn't give us that details, which is why you need to know that when you're calculating your borrowing costs, it should be based on the expenditure incurred if the amount of borrowing is higher than what they spent. But if the amount of borrowing is not, if they spent everything, so just calculate the interest on the loan amount.
Okay, sir. Thank you, sir.
Any other question?
So from your explanation, now we now bring, having calculated this, we now bring back the cost and add up the borrowings to it to get the cost of the asset.
That's correct.
Thank you, sir.
Not a lot of problems. He's shy. He has trouble making friends. He also has trouble making eye contact with people, and ultimately,
Especially when you are watching cartoon.
Sir, no, is where I am. Oh. My sister is there. Sorry. We are leave this place.
Thought you are still watching cartoon.
No, sir. I only watch news.
Football
You know,
monkey.
I want to be president.
There's time.
That's good. It's better.
Maybe I didn't SPPD. President.
Yeah, hello, Mr. Wasiu.
Yeah.
Hello. Yeah, please.
Bro.
I want to ask this question. The only thing I've been seeing here on borrowing costs, as far as this IAS is concerned, is qualifying assets and only
Correct.
speaks to physical assets. Is there nothing like, because all other assets like intangible assets too do have borrowing costs sometimes. So this particular IAS does not say anything regarding them.
You capitalize that also. So even intangible assets too, you capitalize it. So I think the only thing I mentioned something, you would actually capitalize, it covers intangible, is if the asset is measured at fair value. You would not, it does not apply to that. The asset is, if you are like this intangible, even whatever assets, whether physical or intangible, if it's measured at fair value, you cannot capitalize the interest, right? And some other areas too, like maybe you borrowed money for your inventory, for example, inventory that you are manufacturing on a repetitive basis like that. You cannot capitalize the interest you're paying on that. So those two majorly. Every other one, whether investment property, whether PPE, every other one is capitalized. Larry, is that clear?
All clear, sir. Thank you very much.
All right. So I'm done with this topic. Am I permitted to move to the next topic? How many minutes did it take us? Almost 40 minutes. Started from 2:30, 3:30. 1 hour. 1 hour. We overspent time on this one. So let's see if we can leverage this. If we can spend lower time on this. So let's finish this in 20 minutes. So this is also a very short standard. So I'll not be typing everything I'm saying here because I already have it here. It will be a little faster. So this standard deals with, is IAS 20, and it deals with accounting for government grants and disclosure of government assistance. So two things, government grant and government assistance. And the standard did not make mistake when they said accounting for government grants and disclosure of government assistance. They didn't make mistake because they are not so the same. Government assistance and government grants are not the same. So government assistance is the entirety of the action by government to provide economic benefit. So all the benefit that everything government does is government assistance. That's everything they do for entities in terms of providing benefit to entities. is government assistance. So, but government grants is government assistance too. Government grant is government assistance also. But for grants, you are providing economic resources to entities in return for past or present conditions that the entity has met. So to a large extent, government grants is more of cash or something tangible, something we can measure. Government grant. Just if government says they want to give subsidy or they want to subsidize your staff salary, or government says that we want to give you an asset so that your production can be facilitated, that's government grant. But government also provide other assistance beyond money, beyond those monetary value items. They provide other assistance. They can provide technical advice. They can provide training and education, right? Those other ones they're not giving you money, but they are still assisting you. Those are government assistance. Those ones, if you get government assistance, you did not get money, so there's no way you can account for anything there. There's nothing to account for. You only disclose those ones. And that's why the standard reflects exactly how we account for each of those items. So when you have an assistance, when you collect money or when you get an asset, that is a government grant. Any other one is assistance. Government assistance, you disclose those ones. That's one. The focus, therefore, is government grants, not government assistance, because we know that that is basically disclosed. So when you get money from government or you get any asset from government, how do you recognize it in your books? First, there are two recognition criteria. Number one, you have to be reasonably certain. You must have a reasonable assurance that you can meet the condition attached to the grant. You need to be sure that you will meet the condition. Government won't just give you money. They must have seen that whether you have employees, whether you are doing this, then that's why they say, okay, let's subsidize your operations. Let's give you this. You must be seen to meeting that you can meet the condition. Otherwise, you would repay. They would ask you to bring back the money. So also, besides meeting the condition, you must also have a reasonable assurance that you will receive the grants. It has to be a serious government making serious commitment. You have to have reasonable assurance that the grant will be received. So they are linked together to a large extent, these two recognition criteria. So when these two recognition criteria are met, and you can then go ahead and recognize the grant in your books, but at how much? How much are you going to put in your books? It depends. It depends on whether the grant is a grant related to assets or a grant related to income. So the grant related to assets is where the government gives you an asset, or the government says that we are going to give you money if you buy an asset. Or the government says, because you have bought an asset, we are going to subsidize the assets. Like, let's say you bought an asset for 100,000. Government can say, yeah, take 50,000 back. That's a government grant related to asset. Is that government gives you an asset, or they ask you that, okay, go and buy the assets. We will give you a grant if you buy assets, right? Or they simply subsidize you for buying an asset. That's grant related to asset. Any other grant that is not related to assets is a grant related to income. So when government gives you grant related to assets, two ways for putting it in your books is either the grant you collected from the government, you simply deduct it from the costs of the assets that you bought. So if the cost of the assets is 100,000 and the government gave you 20, so that means you recognize 20 in your books. Sorry, you recognize 80,000 as the cost of the assets in your books. Or you can recognize the grant as a liability. You set it up as a deferred income. You see, this second approach is the preferred approach. Because with this one, you are not tampering with the cost of an asset. You would make sure that the consideration transferred is the cost, and you're not doing offsetting, right? You recognize the entire cost. So the grant that you collected from government, you debit bank, you go and credit a deferred income. Acknowledge the fact that is a liability until you have met all the conditions, because grant is not something you just recognize one-off in your books. Since it is attached to a condition, it's usually recognized over the period it will take you to meet that condition. In the case of an asset, you are going to recognize the grant over the useful life of the asset. So this second approach is the preferred approach, where you set up the grant as a deferred income. It's better than this first one, when you are using it to deduct the cost of your asset. It's distorting accounting principles. But you see the one that is related to income. This is a government grant that is not related to asset. And like government gave you some money to train your staff, they give you money to support your wages and salaries, money that has nothing to do with buying asset. That's grant related to income. Two ways. Present it in your P&L as an income, as a separate line item in income, or you can net it off against any related costs. And again, you need to understand the fact that if there are conditions that are related that you need to meet, before you can be entitled to the grant, then you should know that you need to spread that grant over that period. It will take you to meet that condition. But if the condition has already been met in the past, that one, you recognize it immediately. And that is everything for government grants and government assistance. Any question before we solve questions? I told you they were short standards. Any questions? Okay, that means I can go ahead to solve questions. Just hold on one sec. Okay. The first question says that a company receives a 20% grant towards the cost of a new item of machinery, which costs 100,000. The machinery has an expected life of 4 years and a nil residual value. The expected profits of the company before accounting for depreciation on the new machine or the grants amount to 50,000 per annum in each year. Show the accounting treatment for the grant received. Okay, so from this question now, we receive 20% grant towards the cost of a new item of machinery that costs 100,000. This is clearly a grant related to assets. This is a grant related to asset. And we are now told the useful life of the assets and all that. And they told us the company used to make profit of 50K, show the account treatment. So let me use this to show you the two methods of accounting for grants related to assets, deducting a grant from the carrying amount and setting it up as a deferred income. So the first method, which is deducting the grants from the cost of the assets. That means in our books, the government gave us 20% of the costs as grants, which is 20,000. So in our books, the cost of the grants would therefore be 80,000. So if you care to know, this is double entry for that grant received. You debit bank, credit the assets. When you follow this approach, nobody will even know that you collected a grant, except you disclose it. Of course, there will be disclosures. Of course, there will be disclosures and all that. So depreciation also will be based on the cost of the asset, which is 80 divided by 4 years. So you just recognize depreciation per annum of 20,000 per annum. And that is all. You just need to deduct it from the costs of the asset. The second one, which is to set up the grant as a deferred income. When you are setting up the grant as a deferred income, it means that you are going to recognize the liability in respect of the grants, deferred income. Yes, your depreciation will be based on the original cost of the assets, which is 100,000 divided by 4 years, 25,000 per annum. No issue with that. But the grant income will be recognized, this 20,000 will be recognized over 4 years, over the useful life of the asset. Since it was given for an asset that has a useful life of 4 years, you are going to recognize the grant on the same basis as well over 4 years. So in year one, as you are recognizing depreciation of 25,000, you are only going to recognize a grant income of 5,000, being 20,000 divided by 4. So in your liabilities, your deferred income would remain 15,000, since you have taken out 5 to income. In year 2, you recognize another 5,000 as grant income, reduces this to 10,000. In year 3, another 5,000, reduces this to 5. In year 4, 5,000, and this becomes 0. And that's how you do it when it is recognized as a deferred income. And I also need to mention that, is it possible to repay back a grant? Yes, it is if you don't meet the condition. And the repayment of grants, you would have to treat it as a change in accounting estimates. Because if, for example, in year 2 now, this government says that, oh yeah, give us back our money. You did not meet the condition. Return the money. What would you do? Are you going to unrecognize all the 5,000 you had recognized before in the past years? No. That's why the standard says you treat it as a change in accounting estimate. You only adjust current year going forward. You only adjust current year going forward. You just need to unrecognize for the year alone. Remove this deferred income from your books. Remove it. You either debit deferred income and credit bank if you are going to be paying it. You can either return this first, because this 5,002 for that year will have to go. So when you have to repay grants, you don't do retrospective correction. No, you don't go back. Don't stress yourself.
Hello, sir.
You treat it as a change in accounting estimate. So you only
Hello, sir.
just Prince, I'm with you.
Okay, please, I don't know. This 15,000, I don't know if you can explain how you got it. I'm a bit confused.
This
The
one,
non-current
year one.
liability of 15,000. Yeah,
Okay. You know that the deferred income, I'm looking at the second step where you recognize the grant as a deferred income. Okay. And when you recognize the grant as a deferred income for a grant related to assets, you are going to spread this grant, recognize it over the useful life of the assets, meaning you're going to recognize 5,000 naira per annum as income. So in year one, when you recognize a grant income of 5,000, out of the 20, it will remain 15. And that's
okay,
this
okay.
15 you're seeing
I'm
here.
okay.
Yeah.
Yeah, I'm okay.
Okay. Now let's solve it. There's a past question here that we can solve. They said that, yeah, David, I'm with you.
Yes, sir. So my question is, the second method that we're using is as deferred income. It doesn't affect the asset at all.
Yes, at all. It doesn't affect it at all, at all.
But why though? Since the grant is for the asset, shouldn't it at least do something to the cost?
It should not so. It doesn't have to now because the cost of an asset is the cost. I prefer the second method because the cost of an asset is the cost. That is the more amount paid for the asset, right? So it's good that you are recognizing the grant as an income now. That one is good enough. It's showing that, okay, you have an income and you show it because one of the disclosure requirements for grants is you tell us the nature of the grant. So the government already, you would explain it that we got a grant to buy an asset. But let us see the cost of the asset now.
Okay.
Valerie, please read this question for us.
Okay. The federal government of Nigeria is committed to improving medium, small, and micro enterprises (MSME) program. In view of this, the government issued directives to the Central Bank of Nigeria to give grants to MSME that has at least 25% local equity participation required. Explain the two types of grant or government assistance that is recognized by IAS 20 on accounting for government grants and disclosure of government assistance. 2. Outline the two methods of presenting grants or government assistance that are recognized by IAS 20. B. Should I read B too? Or during the year.
Let's answer A first.
Okay.
So, can you just quickly tell me what are the two types of grant that we have?
Grant related to income and grant related to assets.
Okay, fine. So what are the two methods that we have?
Deducting from cost of assets and representing it as deferred income.
Okay, what about for grant related to income? What about for grant related to income?
It will be treated as expenses. I mean, it will be treated as income in the P&L or net off against the related expenses.
That's correct. Thank you. Let's read the second one. Catch it on.
During the year ended June 30th, 2019, Gbogbo Niche Enterprise, having qualified for 25% local equity participation, received the following grant from CBN. On September 1st, 2018, a grant of 1 million naira was received from CBN. The grant was in respect of training casual workers. The training cost incurred by Gbogbo Niche Enterprise in this respect was 1.75 million. On November 1st, 2018, Gbogbo Niche Enterprise acquired plants and equipment costing 8.75 million naira and received a grant of 2.5 million naira from Central Bank of Nigeria in respect of the purchase. The plant and equipment, which has a residual value of 1.25 million naira, is depreciated on a straight line basis over its useful life of 5 years. On June 1st, 2019, a grant of 2.5 million naira was made by CBN. The grant was in respect of reallocation costs that Gbogbo Niche Enterprise had incurred for the movement of its business to a free trade zone allocated to medium, small, and micro enterprises. The grant is repayable in full unless Gbogbo Niche Enterprise recruits at least 100 employees from the free trade zone local area by the end of the month of June 2019. Gbogbo Niche is finding it difficult to recruit this number of employees in the local area. Required: prepare extract of the statement of financial position and statement of profit or loss of Gbogbo Niche Enterprises for the year ended June 30th, 2019, using the two methods of presenting grants in the financial statement of business entities.
Thank you. So we're asked to prepare an extract of statement of financial position and statement of profit or loss of Gbogbo Niche Enterprise for the year ended June 30th, 2019, using the two methods of presenting grants in the financial statements of business entities. So now, for this one now, we need to work some items out. We need to know how much is going to P&L, how much is going to statement of financial position before we can prepare. Because the question actually asks us to prepare an extract of some statements. So, given the details, I can see that the year end of this company is 2019, and the company is Gbogbo Niche Enterprises. He has qualified under 25% local equity participation, and for that reason, CBN has decided to give it some grants. So probably CBN requires that local investors must have at least 25% in your company to get a grant. So the first grant happened some 6 months ago, the year end is June. This September, October, November, December. That's 9 months, January to June. 9 months. 9 months ago, he got 1 million from CBN. And this grant was in respect of training of casual workers. The training cost incurred by Gbogbo Niche in this respect was 1.75 million. If I may ask you, Is this a grant related to assets or a grant related to income?
Related to income.
Good. This is a grant related to income. So, and it's very straightforward to treat. Is that you present this 1 million in your P&L straight for that year, or you net it off against this 1.75 in such a way that the only expense you present in your P&L is just 0.75, or you net it off against that. So the second one, this grant came in November. That is around November, October. That is 8 months. November, December, January to June. So on November 1st, 2018, Gbogbo Nishe Enterprises acquired plant and equipment costing 8,750,000, and it got a grant of 2.5 million from CBN in respect of this purchase. The plant and equipment, which has a residual value of 1.25, is depreciated on a straight line basis over its useful life of 5 years. It's clear that this is a grant related to assets, so no issues. And on June 1st, 2019, that's a month ago, a grant of 2.5 million was made by CBN. The grant was in respect of relocation costs that Gbogbo Nishe Enterprises had incurred for movement of its business to a free trade zone allocated to medium, small, and macro SME. The grant is repayable in full unless Gbogbo Nishe Enterprises recruit at least 100 employees from the free trade zone local area by the end of the month of June 2019. Gbogbo Nishe is finding it difficult to recruit this number of employees in the local area. Okay. So he got another 2.5 for relocation. Definitely, this is a grant related to income too. But the condition, they say this one, that he can repay in full if he does not recruit 100 people from free trade zone. And now they are telling us he's finding it difficult to do that. So he needs to go and recognize this as a liability, as grant repayable, because he might likely have to repay. He cannot recognize this as income at all. He would rather go and put it as a liability. The grant related to income should just go to P&L. You debit bank, credit P&L. But in this case now, this guy cannot credit P&L because he's not meeting the condition. He's not. So he cannot go, he will just go and recognize the liability as grants that he might have to repay. Grant that he might have to repay. Now, with this insight, we can then go ahead and solve the questions. Because the question says that we should use the two methods of presenting grant in the financial statement. So the first grant is a grant we established as a grant related to assets. Is a grant related to income. So is either we present it as a separate line item in P&L or we net it off against the 1.75. The second one is a grant related to assets. We got 2.7, 2.5. So the first method is deduct it from the cost of the asset. The cost of the asset was 8.75. We received a grant of 2.5. Just deduct it from that. So what we'll present as cost of assets in our books will be this, 6.25. With this understanding, then our depreciation will be on the basis of this 6.25. So it will be 6.25 minus residual value, because we are given a residual value of 1.25, and the useful life of the asset is 5 years. When we do that, we should get the depreciation per annum. But considering that this grant came in November, and our year end is June, So that's 8 months. That's why we need to depreciate this and prorate it to 8 months. And that gives me 667. If I take that away, if I take that away from the cost of the asset, so I have a carrying amount of 5583. Then I can move to the second method, which is to set up the grant as a deferred income. So in that case, the cost of the plant would be untouched. So our depreciation will be based on the cost of the assets. So the same thing minus the residual value divided by 5 times 8/12. So that's 1 million depreciation per annum. Then our carrying amount is the difference. However, since we are setting up the grant as a deferred income, that means this amount of 2.5 million grants, if you are setting as a deferred income, you are going to recognize it. The grant received will be recognized over the useful life of the asset, which is 5 years. So in year 1, it will be 2.5 divided by 5 years. But since the grant came in 8 months before the year end, on 1st of November, and our year end is June, so multiply by 8/12. So 2.5 divided by 5 times 8/12, that gives us 333. So we're going to recognize this amount as income in P&L. The balance, the unrecognized balance, which is 2.5, the total grant times the income recognized, the balance is 2167. That's will be recognized as a liability. The third grant is also a grant related to income because it's received for relocation. But since the entity is finding it difficult to meet the condition attached, so you should just recognize the grant as a grant repayment under liability. So let's prepare our P&L. The first method, the grant received, I'm presenting it as a separate line item. Okay. And that's the only one that comes into P&L, the one relating to training of staff. The one relating to assets, it does not come to P&L, it's deducted against the cost of the asset. So then my depreciation that I computed, 667, under that method 1, this depreciation here. And that's all that goes to P&L. In my statement of financial position, the carrying amount of my asset is 5583, which is that cost minus the depreciation that we did. And for the third grant, which is grant that we have to repay because we did not meet the condition, I'm putting that as a current liabilities, and it's 2.5. The second method, for grant related to income, I net the income, the grant received against the related expense. So I have an expense of just 750. My depreciation is computed as just 1 million. And the grants related to assets, since I'm setting it up as a deferred income in method 2, so the portion of the deferred income recognized to P&L this year is 333. That comes as an income. And in my statement of financial position, this is the carrying amount of the assets is 7750 as computed under method 2. If I want to remind you, this is it. Cost minus the depreciation. Then the balance of my deferred income, which is the 2160, the unrecognized portion, the one I've not recognized as income. And I have my current liabilities. So I would then recognize repayment of government grants as the current liabilities of 2,500. 2,500. And that is all for that. And that's the end of this question. Any questions? Okay, David, go ahead, please.
And so it's a very simple question. Please, if you want to recognize the deferred income for the subsequent period, say it's going to be the current amount divided by 4. We're not going to use the 333 again.
Say it again, I didn't get you.
I said when we're recognizing the grant income for the subsequent period, we have to divide the current amount again by 4, right? Not like we're going to use the prorated amount.
Yes. Because that one is a full year.
Okay, thank you.
Beatrice, I can see her hand. Go ahead, please.
Yeah, good afternoon, sir. Please,
Good
that
afternoon.
the Roman figure 1 question. So I don't know how you solve it. I'm only seeing from Roman figure 2. Please, can you help me to show to Roman figure 1 solution? Okay. That's it. I'm going to say okay.
Any other questions?
Yeah, hello, Mr. Wasu.
Yes, me too.
This question, it's a little bit absurd in my own head also, but bear with me. What about grant if it's the organization giving out grants? How do we account for it? Because what I see is grant received. There is nothing like organization giving out grants.
That's just an expense for them. And
Or just an expense.
yes, and they will pay dearly for it. The taxman will
Daily.
disallow it.
Well, you said daily.
Yes, the taxman will disallow it. Except if, because it's similar to donation, right? Except if it is to a recognized body under the old law. I think it has changed now. So that's that one. It's just a normal expense. Okay, let's struggle to do like additional 20 minutes. Yeah, this one. We spent another almost 30 minutes on this one too. So let's do IAS 40. Investment property. So
Sorry, sir. Can we run away?
no, don't, because did we solve question in class? So I think Now we know that we are done with this. It won't be holding us back again next week. But they are very straightforward questions. You're a smart guy, so you can run away.
They will
So
listen to the record lecture.
exactly, it's recorded. Now, IAS 40 talks about, it's a very short one. I'll be done in like 20 minutes or thereabout. And I'll allow you guys go for now. IAS 40 talks about how do you recognize and how do you measure investment property? And when we talk about investment property, we're talking about land and or building or part of a building that is held for income generation or capital appreciation. So investment property, as the name implies, they are properties, land or building, or the two of them. It could be part of a building, right? And the aim of holding it is for you to generate income, rent, or for you to leave it to appreciate. So examples are, if you have a land that you just buy somewhere, you leave it, you're not using it for anything, or probably maybe you don't even know what to use it for. That means you're holding that for capital appreciation. That's investment property. Or you have a building that you leased, okay, and you decide to also lease it out or rent it out to another person under an operating lease. That's an investment property. If you lease it out under a finance lease, you know that cannot be an investment property. That would be you need to recognize the net investment in the lease, not investment property. But if you lease asset out under operating lease, that's a short-term lease. That's an investment property. The asset you leased out is your investment property because it means you're going to be collecting rent from it. So if a parent entity leases a building to its subsidiary under an operating lease, in the account of the parent, the building is an investment property. In the consolidated account is PPE because in substance, the parent has an investment property because it's collecting rent. But for the group, the group is an economic unit. Any transactions between the parent and subsidiary is neutralized, is not recognized. So as far as the group is concerned, no transaction can occur. So is PP because it's seen as we are using the asset within the group since one of the parties is using it, which is the subsidiary. So it's treated as PP. So a building under construction and you intend to use it for investment property, that's also an investment property. Even though it's not completed, it's still under construction, you will still recognize it as an investment property. But if you have land and building, that the intention is to hold it for supply of goods or services, or you're holding it for administrative purposes, that one is PPE. It's just like a company that has a land beside them, and the aim of that land is to enable staff to park. That's the intention of holding it. That's what they're using it for. They are holding it for administrative purposes. That land, they cannot recognize it as PP. It's recognized as, they cannot recognize it as investment property. It's recognized as PP. Or if you have a land or building that you are holding to sell, that's inventory, not investment property. Okay, so that's introduction. Now let's go into some other issues but before then, I can see one hands up. Can you go ahead with your question quickly, please?
Okay, sir. Thank you. My name is Ako. I'm calling from Meduguri. Yes, sir.
Nice to meet
I'm
you, sir.
calling. Thank you, sir. This investment property, I want to understand something. Is it only land and building that fall into this category? Because as a person staying in the north now, precisely Meduguri, there is one kind of business that is being practiced in this part of Nigeria that I don't see in other places like that. Somebody may raise bull, bull. They
Cow.
use them for farming here. Yes, cow. They use it for farming here. People raise it not for they don't keep it not for childbearing, so they cannot be categorized as biological. I mean, bearer. Is it bearer as animal? And they are not purposely for childbearing, but to farm. They will rent it out. People will use it to farm, then return this thing, give them return, just the way they rent land and other things. So, and I always keep thinking that kind of business, one cannot treat it as a IAS 41. No, IFRS 41. And you cannot say it is a inventory to treat it under IAS 2. So before now, I always think it can be treated as investment property. But looking at the context of investment property, it's like it's only related to only plant and building. So I want to hear your opinion. How can one handle that kind of a business, sir? Thank you.
Okay, thank you very much. Is there anybody that have experience in farming here? Enoch, I think you do farming.
Not exactly, but I've been involved in it. And
Can you speak to this?
I also stayed in the north for a while.
Yeah.
So, yeah, what I would say is it hasn't been recognized under the purview of IFRS 40 or even the O and IFRS as a board. And another thing is there's something called qualifying asset like it's always and to say that yes, the pool have trained for.
Mr. Enoch, I can hardly hear you, please.
Oh wow.
Enoch, we can't hear you.
Speaking of, can you hear me now?
Yes, can hear you now.
So I said I would say it hasn't been recognized under the purview of IFRS 40. I mean IAS 40, right? And it does not hold the real characteristics of
You stay close
what
to your
the
mic.
I'm very close to my mic, but you're not here.
Okay, yeah, I get your point, Enoch. So just so that we'll move very fast. So that's a good question, Mr. Eko. So it's not an investment property, clearly, because they are basically land and building. Anything beyond that is not an investment property. So it's clearly not an investment property. Since it has to do with animals, plants, and all of that, any assets in that respect would fall in the purview of it will fall under biological assets. Okay, so this one is clearly, it's still going to be a biological asset because it's a living animal and is making income for you. So for that reason, it's a cow that you're renting out for people to farm and all of that. So the rental income, you recognize it separately because you'll be getting income. That one, you put that as your income. If you can get the value of the cow, most likely their fair value, it will be their fair value, because you want to look at, especially the one, because they are giving birth periodically. So get their fair value at the end of each year, and at that value, you are going to put it in your books, right? And that's how it works.
All
Yeah, I
right,
can see
thank you.
you. You're welcome, sir. Yeah, Beatrice, you can see your hand.
Please, my question is that let's say a company that has staffs purposefully builded a hostel or a accommodation for the staffs, and those staffs they are to pay the rent at market price, not subsidized rate. Oh. Can that be regarded as investment property? So,
Yes, it is, because it therefore means that they are holding it for rentals, for rental purposes. They are holding it for rental purposes. So it is an investment property. It is an
okay.
investment. Yeah. So now,
Okay.
yeah,
Thank
you're
you.
welcome. You're welcome. Now, two issues, quickly. One is when you have a building and part of the building is used for rent, you're renting a part of it out, and a part of it, you're using it for your, let's say, head office. That's for administrative purposes. So that building, are you going to account for it or classify it as an investment property or PP? Okay. And we want to resolve that very quickly. The standard says that where each of those components can be sold separately, that is the one that you're using for rent, you can sell it separately, and the one that you're holding for your head office or administrative purposes, you can sell it separately. Then you are going to treat each of those components separately. Okay, just like you have a 10-story building, you're using 5-story for your office use, you're using the other 5-story, you rented that out. So we're saying that if you can sell each component separately, then the components that you're renting out, you're going to classify that as an investment property in your books, while the components that you're using, you're going to classify that as PP in your books. And that's how you resolve that completely. But if you cannot sell them separately, if it's impossible to do that, that you can say, okay, I want to sell a floor or 2 floors or 3 floors out. Then in that case, the standard says the classification should be based on significance of use. Significance of use, which means that is the portion that is significant that will determine the classification of the building. If it is the portion of rent that is significant, you are going to classify the entire building as investment property. If it's the portion for usage, for your office use that's significant, you are going to classify the entire building as PP. And how do you determine significance of use? It's based on management judgment. We leave it to management to determine the definition of significance of use. We leave it to management to determine. And that's all for that. The second one is ancillary services. And what this means that when you have, for example, an hotel, that's the cleanest example I can give you, an hotel. An hotel looks like an investment property because it's a building that you are renting out for the purpose of collecting rent, of course. So it looks like an investment property. But it is not, because the level of ancillary service is significant. When I say ancillary service, I mean services that involves provision of water, security, electricity, and other amenities. In fact, soap in some instances, everything that all the tenant just needs to do is just to pay, and with his wares and apparels, he goes in for whatever number of days he wants to spend, and he pays. That's all they need. Everything is provided. you cannot classify that type of building as an investment property anymore. It then becomes a PPE because that is beyond just holding something for investment. Now you are holding it for a major business because now you will need to employ people. You will need to employ security. You need to employ cook. You need to employ receptionist. You need to employ this. That has already left the purview of the idea behind investment property. Investment property is supposed to be a side gig. Supposed to be something that you have invested and you forget. It's not something that you now be involved and be paying salary and be paying tax on pay and all of that. That one has become a business and that building becomes your PPE. And that's the issue around ancillary services. Okay. Moses, I see you. Please quickly ask a question.
Yeah, sorry. For this you mentioned now, I think my parent company, we are into luxury rents. It's luxury, they call it luxury. So we don't just rent it out. We have security on board. We have maintenance staff on board. Yeah, and they are always on duty 24 hours to ensure that the building is running up and down. Now, in this kind of, me and my SC, we have agreement in this regard. I think last year, we were charging depreciation on it before the man joined. The man has said, no, it's investment property. We have to classify them as investment property, not PPE. But this one you mentioned now, me, I have not heard this one before. So can you just give it a little bit of clarification on it?
Okay, so if you have even so, is yours operating like a shortlet?
No, sir, it's not shortless. Someone that won't come and rent for a whole year. But TV, so we provide TV for those tenants. Even some amenities in the building, sometimes we provide all those things for them. Chef and the rest
So
of
they pay service charge to you guys.
Definitely.
So you guys run an agency.
Is agency now?
It's PPE now.
Okay, it's PPE, not investment property.
Yes. So you are into all these people that rent building and collect money from it, Abi?
Yes.
That's your business now. It's PPE now.
Okay,
That's not the idea of investment property under IAS 40. So investment property is the aim, yes, is land and building that you're holding for capital appreciation and in some cases income generation. The whole aim is for investment. And that's why when I get to the measurement basis, you see that it's measured at fair value. It's not something that you are using for your core business. If your core business is rental agency, if your core business is hotelier, is where you need to service the place when you have people working there and all that, then that one is beyond, you can't call that one investment property. If it was a situation whereby you have an investment, if you guys were doing something else entirely, you now have a property, you now give it to an agent that the agent should manage it for you. That at the end of the year, you will just be collecting a lot. That one is investment property. Even if you have an hotel that you'd enter into a contract with some people to manage it for you, that all you want to know is at the end of each year, don't let my 50 million miss. So you already have plans on what you want to do with it. That December 25th, bam, 50 million has entered. That's investment property. That's the aim. That's the idea behind investment property. Not when you are running it. No, that one is PPE.
Thank you, sir. Very
You're
clear.
welcome. Good. So recognition of investment property is exactly the same as PPE. It has to be probable that there will be an inflow of future economic benefits, and the cost can be measured reliably, and is also measured initially at costs. All those components of cost you learned in IAS 16 applies here. And at the end of the year, it's usually measured either using cost model or fair value model. So cost model is exactly the same as you have learned before. It's cost minus accumulated depreciation minus accumulated impairment losses. Fair value model is fair value. When you are measuring an investment property under fair value model, you do not depreciate. Fair value model is different from evaluation model. This fair value model, you don't depreciate. You just get the fair value at the end of the year, then you get your value. So that therefore means that there might be changes in fair value. So for fair value model, any changes in fair value goes to P&L. This is also different from that of PPE or intangible asset that use evaluation model. Those ones goes to it goes to OCI. But since here you're using fair value model, it goes to P&L. Goes to P&L. And finally is disclosures. So disclose the measurement basis used, depreciation method, rates, how you determine your fair value, how you determine level of ancillary services, how you determine significance of use, and all of that. And that's the end of investment property. So what's left now is for us to solve questions here. Any questions?
Sorry, I didn't get your explanation. I think the network threw me off also. I didn't get your explanation on the recognition criteria.
It's the same thing as PPE. Exactly the same thing as PPE. And the measurement basis is costs. Subsequent measurement is either cost model or fair value model. Cost model is the same. Cost minus accumulated depreciation minus accumulated impairment losses. Fair value model, you use fair value. You don't depreciate this. It's different from evaluation model. And whenever there is changes in fair value, you take it to P&L. Whenever there's changes in fair value, it goes to P&L.
Okay, that means for both investment property and PPE, if you are using cost model, that means you need to depreciate the two assets, right?
That's correct, yes.
All right, thank you, sir.
You're welcome. Okay, now let's quickly solve these few questions that we have. So they said a business owns a building which it has been using as head office. In order to reduce costs on 30th June 2019, it moved its head office function to one of its production centers and is now letting out its building, its head office. Company policy is to use the fair value model for investment property. The building had an original cost on 1st January 2010 of 250 and was being depreciated over 50 years. At 31st December 2019, its fair value was judged to be 350,000. How will this appear in the financial statement as at 31st December 2019? So if you look at this question very closely, this business, he has a building, he has been using it as head office. That means it's PPE. So he wanted to reduce cost in June 2019. So he moved his head office function to one of his production centers. And now he's letting out his head office. So the building he was using for head office before, now he decides to let it out. And they use fair value model for investment property. So that means there is a change of use. There's something we call change in use. What they were using for PPE before, now it will be used, it's now being used as investment property. That means you need to reclassify the asset from being a PPE to investment property because of change in use. That one is not a problem. So the challenge is at what amount do you do that? At what amount do you do that? So you will learn one of it here now. So now, in this instance, since you are moving from PPE to investment property, it means that, and they didn't tell us anything around whether they were using evaluation model for the investment property or what have you. So in this, but they decided to use fair value model for the investment property. Since they are using fair value model for the investment property, that means at the date of change in use or at the end, you might need to get the fair value of the assets, and that will become the value. That will become the value of that, what do they call it? The value of that investment property going forward. And the examiner had already given us that because when they bought the asset like 2010, it was 250. But at the end of the year, they got the fair value at 350. And the reason they had to work out this fair value is because the investment property is being measured at fair value. So what we have at hand is a situation where there is a change in use. A building they were using as PPE before is now being classified to investment property. So first, what you need to do is that at the date of change in use itself, what's the value of that PPE? Remember the fact that the cost of this PPE was 250,000. And since they didn't tell us that it's evaluation model, so it's definitely cost model that they were using for the PPE, so they were depreciating it. And the useful life of this PPE in this case was how many years? It's 50 years. It's 50 years. So it's going to be 250 divided by 50. That will give me depreciation per annum. Okay. Multiply by 9.5 years. Because change in use happened in June 2019. And I bought the asset in 2010. If you count from 2010 to June 2019, that's 9.5 years. So the accumulated depreciation, therefore, is 47,500. If I should take that away from the cost of the asset, I get a carrying amount of 202,500. And this is the value of the asset at the date of change in use. Ordinarily, this should have become the value of the investment property if the investment property is being measured at cost model. But since the investment property is being measured at evaluation at fair value model, so they gave us the fair value of the investment property at the end. So at the end, the fair value is this, and it is at this value that you're going to recognize the investment property. Now, because of this fair valuation, there was a difference. There was a surplus of 147,500. And I'm taking it to OCI. And it's going to OCI because this asset was just changed from PPE to investment property. So you are going to treat it based on the old use. Whatever surplus you get will be treated based on the old use. Based on the old use. Subsequently, any gain or fair value surplus that happens on these assets, that will go to P&L because changes in fair value goes to P&L for investment property. That's what distinguishes fair value model from evaluation model. Changes in fair value as a result of using fair value model goes to P&L. But if you are using evaluation model, it goes to OCI. But even though we are using fair value model to calculate this, to determine this investment property at the date of change in use or at the end of that year, that cannot go to P&L. Because whatever surplus we had is coming as a result of the old use. So in the first year of change in use, whatever surplus you get will be based on the old use. And that's why this is going to OCI. And that's the solution to this question. That's the solution to this question. Any questions before I go to question 2?
Sir, but I wanted to ask, when since this renting out thing is not a normal business operation, why would the subsequent increase be in subsequent revaluation be in P or L?
That's the whole idea of investment property now. That is your side gig. It's something you just have. It's just generating income for you. It's not your core business. If it's your core business, it's PPE now.
Yes, but like you said that like subsequent revaluation under fair value, the gain would go to P or L, not OCI.
Yes, now. That's
Yeah, but it's
the
not okay.
that's the whole idea behind fair value model. That's what distinguishes fair value model from evaluation model. Fair value model, we believe that gain is a real gain because you can decide to sell the asset anytime you want. It's a gain. So you take it to P&L as other income.
Okay, sir, sorry. I wanted to ask, what is like the reasoning behind this gain on disposal or gain on revaluation is in OCI, or this gain is in P or L? So that like, not make a
Yeah, so the
mistake.
one that goes to OCI, we see it as an unrealized gain. And because of the nature of the assets, like PP investment property, sorry, PP intangible asset, the asset you use for your operations is not something we even expect you to sell anytime soon. We don't expect you to sell it. In fact, you don't have the intention to sell it. So if there are changes in fair valuation of those type of assets, take them to OCI. Go and put them in a reserve called evaluation reserve. But investment property, they are assets you hold for investment. The assets like land that you don't even know what you want to use it for, it's just there. So when you make a gain on that, you should take it to P&L because it's fair value. The gain is real. It's not an asset that you might hold for forever. It's something you might just decide to sell anytime. So put the gain in P&L. So any fair value, whatever changes you get, goes to P&L.
Thank you, sir.
Yeah. Question 2. It says if a property is transferred into or out of the category of PPA, it might be classified as investment property or as no longer as investment property. A transfer of investment property can only be made where there is a change of use of such property required. Identify 4 circumstances that may lead to recognition or the recognition of an investment property under IAS 40 and state the accounting treatment under each circumstance. So 4 circumstances that may lead to recognition or the recognition of investment property. First, recognition of investment property is 1, if you acquire an investment property, then you measure that at cost. Then at the end of the year, cost model or evaluation model. If you buy, then it leads to recognition. Number 2, if there's a transfer from PPA to investment property. Okay. So if the investment property is measured at cost model, then the value of that investment property at the date of transfer will be the carrying amount of that PPA. But if the investment property is measured at fair value model, then the investment property will be measured based on the fair value of either the valued amount of the PPA or the fair value of the investment property. So it's more of, since it's not investment property, it's more of the fair value of the investment property. That's how it will be measured at the date of change in use. So it's not only these two, because the examiner said I should mention 4. So I mentioned 2 for recognition, 2 for the recognition. I could mention more. It could be transferred from an investment property held for sale, meaning that is an inventory, transferred to an investment property proper. That, okay, I'm not selling it again. I want to hold it for rent and all that. Also, that one is also measured at the fair value, the selling price of that inventory. That would be the value of that investment property. So those will lead to you recognizing investment property in your books. It's either you buy it or there's a transfer. There's this transfer as a result of change in use. As a result of change in use. Whether you decided to change an office, your office, you move from there, you decided to rent it out, something like that. It becomes investment property. Like that. And the recognition. So the following circumstance is either when you recognize it was an investment property before you made it PPA. Okay? Or it was investment property before you change it to inventory. That is, you are now holding it for sale. Okay? So those one will result in you removing investment property from your books. And if the PP is measured at cost model, then the investment property will be measured at the carrying amount at the book value of that investment property. But if you are using evaluation model, then you might need to get the revalued amount of the PP at the date of change in use. That would then becomes the value. If you are transferring from investment property to inventory, so the inventory will be measured at fair value of the inventory at the date of change in use. Any changes in fair value will recognize to P&L. And this is just for 8 marks. Another question. It talks about Young Shall Go Limited as a year end of December 31st and purchased an office building with a useful life of 50 years for 55 million on January 1st, 2013. The amount attributable to land was negligible. The company used the building as its head office until December 31st, 2017, when the entity moved its head office to a larger premises. The building was classified as an investment property and leased out under a 5-year lease. However, owing to a change in circumstance, Young Shago took possession of the building 5 years later to use it as head office once more. And at that date, the remaining useful life of the building was confirmed 40 years. The fair value of the head office is this. Okay, go and attempt this yourself. Similar to what I've been explaining so far. And this one, when I share the notes, you'll see it. I need you to attempt this one too. This one is, go and try and attempt this yourself as well. So I'll share these notes with you. Let's get it studied for this evening class. So I'll stop here for now because I've overspent my time with you. We would continue our class in our second period. Any questions?
When is the second period, please?
8:30.
Are we
Thank you,
supposed to
sir.
join the physical favor?
I mean, it's in your interest to join. I just heard that Mr. Ibrahim said he has not taught you guys financial instrument and he won't even have time to teach it. And I thought he has done it already. So, better for you to join. Bye. See you.